Welcome to part 2 of putting a plan into action for first-time home buyers in high cost of living areas. Proven strategies that have worked even over the last 30 months, which have been the worst and least affordable markets for first-time home buyers, especially for you folks in the high cost of living areas. More secret solutions that shouldn't be a damn secret. Let's hear them.
How to Buy a Home educates, protects, and connects first-time homebuyers to qualified vetted realtors in their area. Whether you're looking for DIY information or step-by-step guidance, How to Buy a Home is the #1 resource for first-time homebuyers.
What's happening, How to Buy a Homies? David Sidoni here, and not only do I have secret information to help you, but I also have some great news to get started. We're seeing a subtle dip in the housing market, and it is favoring buyers. Yes, thanks to the war in Iran, the big spring surge of home buyers that usually happens and that we anticipated would happen this year, it's not happening. And the winter window of opportunity, it's staying open a little bit longer. Right now, there's less competition. And this year, it's the weakest start to a year for home prices since the early 2010s. Prices are only up 0.8% from last year. But at the same time, inventory's grown 4.2%, and more than half of the listings that are out there right now, they've been on the market for over 60 days, which means the sellers are paying some or all the closing costs, making concessions to get deals done. Yeah, and a lot of the sellers, well, they didn't anticipate this happening, and they're confused right now. The Google searches for "I can't sell my home," that number is skyrocketing, and people are reporting about it because it's at levels we haven't seen since back in 2008. Now, keep in mind, this isn't happening everywhere in the country, but in more than half of the country right now, it is a really serious buyer's market. With the top 10 best buyer's markets ranked like this. Number 1, Jacksonville. Then we got Birmingham, San Antonio, Atlanta, Houston, Detroit, St. Louis, Raleigh, Baltimore, and Louisville. You guys out there in Louisville, I said that right? Louisville. Okay, but today we're going to be concentrating on part 2, the deep dive into those of you out there who are paying high rents in high cost of living cities. Now, your buyer's market is different than the cities that are on the top 10 list. Most of those are what we call mid-size economic regions. And this will be specifically for you. Now, you did have homework after part 1, remember? Because without all the math behind these strategies for you, you're not going to be able to see the complete and full formula, which means you won't clearly be able to figure out what's the best choice for you. So I got to ask you, did you go back? Did you do your homework? Did you get all the math? I told you that we're in a really opportune dip for buyers, but I don't know how long this is going to last because of that one pesky data point that came in your homework. It's in the formula right there, supply and demand. Say it with me now, everybody. That's called low inventory. Now, the data behind the supply and demand, low inventory, and all the rest of the math, that was in these episodes. 426 for low down payment options, 440 for the rent replacement strategy, 443, the math on true affordability, 457 in 2026, should you buy, should you wait, and then 460, the ultimate math for renting versus buying. That's where you found out about the 6-column spreadsheet formula. And finally, episode 464, PMI, breaking that negative myth once and for all. Well, I should say once and for all because I had to do this 3 or 4 times a year. I've been coaching it since 2006. So to get the most out of this episode, you gotta know the math from those episodes. And gang, this isn't difficult to figure out. It's not too complex to understand. It's just not something that big real estate is teaching. So it seems like it can't be done. You can do this, and it will be a huge financial W for you. The math will show you the huge leverage that you have to make financial gains. While most people right now in your position, a lot of them have given up because they don't have all this data. The math is there for you to start making your money work for you today instead of waiting for a better option. So if you need to, pause right now. Listen to those. Take the time. Do the research. It's important for you to grasp all these concepts. So I'll put the links for those in the show notes. In high cost of living areas, there's a new path to home ownership that follows a basic economic principle for home buying in a post-COVID housing boom world. Now, it's not as simple as just buying low and selling high. This math is more in depth than the standard rent versus buy versus wait for a better market. Now, in part 1, I shared with you the math, the formulas behind a couple of the financially beneficial techniques to help buy a home affordably without going house poor, even in the high cost of living areas. And today, I've got 2 more to share with you. Now, if you're not in a high cost of living area, you can still benefit from many of the tips and the solutions you hear today. However, if you're a brand new listener and you're looking like, I don't know, dude, where do I even start? Cool. Now, if you're not necessarily in a high cost of living area, you can still benefit from many of the tips and the solutions you're going to hear here today. However, if you are a new listener and you are just going, dude, tell me where to start, we got you covered. The first 10 steps of the home buying process, jump to episode 400. You get all your questions answered there, laid out for you step by step. And we're going to put the full episode guide in the show notes too, so you can look up anything else you have questions about. Like I said, in part 1, gave you a couple tactics that work in 25, 26, and going into 27. The low down payment strategy and adjusting your current monthly savings and retirement contributions to find an affordable monthly option to add a home as a diversification of your portfolio. Those were the first 2. Today, I'm going to give you 2 more. Adjusting your current monthly savings and or retirement contributions to actually fund your down payment account, as well as using your 401k or your Roth IRA to fund a home purchase. Now, a quick disclaimer. Some people are going to claim that these tactics sound as if I'm suggesting that you should sacrifice your future to buy a home today. I can't tell you how many times people have told me that I'm just another sketchy realtor trying to push people into a big sale. Well, considering that I've been giving these strategies away for free for 7 years, I'm not sure that one really holds water. So for those of you out there who are risk averse or you tentative individuals or even the skeptics out there, this is why when I started talking about this, I began with the math from the homework episodes. This is not an unresearched rant. So let me shed some light on the story behind how this new buying strategy was born and how you can benefit from it. The story of finding affordability in high cost of living areas without going house poor, it's a story that not many renters are hearing anywhere else from all the other people in real estate. And there's a reason for that. It doesn't make those people any money. For about 75 years, the real estate industry is built entirely on a business model that is solely focused on sellers. The buyers, especially the first-time home buyers, well, they're just expected to learn on their own, figure it out, and then just show up. Because the real estate industry thinks that, well, there's going to be a natural progression for young adults as they're growing up. And when they're ready to take that next step in adulting, they'll just be ready to go when they reach out. No way, man. That sucks. This is a huge problem. The detailed information that they should be teaching, but they're not, it would lift up an entire generation of first-time homebuyers and bring them financial stability that they are craving right now. But it's not taught because the broken industry is all about making the quick and easy money. So here we are in 2026, and we're living with these high home prices, these high mortgage rates, this economic turmoil and uncertainty and inflation. And what does the antiquated industry of real estate do? Well, they don't do anything. They're still not doing a damn thing to explain the math for how you navigate this new world. And that includes the realtors and the lenders and anyone recommended by Zillow, Redfin, Homes.com, and any and all of the online mortgage companies. They still believe that you're just going to show up ready because, well, everyone knows home ownership is a smart thing to do, right? Really? Really? You think people think that, right? You think the general public is thinking that right now? Look around. How can you think anyone believes that? Show your work, people. Where's the math behind that statement? So my public service announcement is this. People in high cost of living areas are going to lose on a massive scale because no one showed them the solution. And they are banking on a housing market shift to be their salvation. They're looking for a change, a correction, a drop, maybe even a crash. That's the only way they can see the math working. Well, that thinking is costing potential first-time home buyers gobs and gobs of money, like huge piles of cash. And in this economy, finding creative solutions, this might be the only path to build generational wealth. All the people who need the most education are unfortunately getting the least because the entire real estate industry hasn't ever bothered to explain it to you. Well, that changes here. We got 2 strategies from part 1, and I'm going to wrap it up with 2 new strategies today. The first one we gave you in the last episode was the low down payment option strategy. I saw a survey as recently as last year that said that 62% of Americans say that a 20% down payment is required to buy a home. Oh, so wrong. Every year, 1 million first-time homebuyers buy homes using low down payment options. The average down payment for first-time homebuyers last year, it was only 9%. And the majority of those first-time homebuyers who had to buy on their own without financial help from anybody, those people were using 3% down, 3.5% down, or 5% down loan options. That's what's available, and that's what most people who aren't getting any gifts from anybody, that's what they're using to buy a home. 20% is way off. Low down payment options, they're out there, and they've been out there forever. They exist because the system is designed to allow people to become homeowners without having to wait decades to save up a massive amount of money. The low down payment strategy is the core of you using leverage to grow your wealth. So again, my side mission here, we must, as a country, as a community, we need to raise the financial literacy and education that's going on out there. A low down payment isn't unsafe, and it's not a sign of weakness, and it doesn't always mean it's a house poor choice. It's leverage so that you can enter today's new economic system that is trying really, really hard to squeeze you out. Now, this is all detailed in episode 426, where you learned about the wildly overestimated misconceptions for the low down payment principle. Again, there is so much misinformation about the total math with the low down payment strategy. Waiting for a better market to come along, that's not going to be the cheaper solution. So this is your official warning inside my public service announcement. The analytics and the math in episode 457, they're going to reveal to you without a shadow of a doubt that waiting for that big crash or correction so that things get cheaper, it actually is going to turn out to be a net loss for you on your individual balance sheet. And sometimes I've seen it be just a little bit of an extra for people to get what they really want. We've been working with buyers that are always thinking 5% down, 5% down. That's going to work for them. But then they find one home. Everything's perfect, but it needs just a little bit of work. Well, you know what? They've ended up switching to a 3.5% FHA down payment. Now, they not only get a lower interest rate, but they get 1.5% of their cash that they get to keep. So on a $400,000 home, they're keeping $6,000. That's a big chunk of change. And now maybe they can do a little work, and that home that's perfect in every other way doesn't feel like it's just out of their reach. And the last little tidbit on this is one thing a lot of buyers don't know is you can always put more money into your loan principal if you started with a low down payment in the first place. That's what we call recasting your loan. So that way you do the low down payment so that you can begin the wealth growing clock of home ownership as early as possible. Get that compounding asset to start making money for you. And then if you put 5% down, but you had 15, great. Give yourself a few months, a few years, and then recast the loan by throwing that money that you have that you would have done as a larger down payment. Just do it later. And then it'll recast the loan. You'll get a lower payment and you'll avoid the risks because you'll be staying liquid, having a large portion of your net worth not tied up in the home, but in your bank account until you're ultimately really ready to make that move and put that into the home. Okay, that was one of the hows to do it. I started off that whole section telling you about the why behind the real world examples of using these strategies. And here's the why behind the second tactic from episode 1, temporarily adjusting your monthly contributions to your retirement and your savings accounts, and understanding that's simply diversifying your financial portfolio. The reason why buyers may adjust or reduce their contributions into their other investment accounts for the first few years of their home ownership, most of the time that's to deal with a higher mortgage payment that feels unattainable or unaffordable or just out of their budget. But the math, that's what gives them the real incentive. They do this to start the clock sooner on the compounding gains that they're going to get with a rent replacement strategy because they've done that math. And they want to start the clock sooner on the compounding gains that they're going to get with a rent replacement strategy of home ownership. Because once the home purchase is complete, they realize that they can slowly build up the contributions again. But you can't go back and start the clock any earlier. That's the first thing that needs to happen. And understanding that when you're doing this strategy, it's not taking away contributions from your future. You're just putting them into a different savings vehicle. For most Americans, home equity, that's the largest piece of their overall wealth. And the sooner that you own, the bigger that wealth is. A home should be viewed as part of your overall financial portfolio. I'm not saying that a home is a great investment and you're going to turn and burn and make a ton of money. This isn't investing. This isn't house flipping. This is for the regular person who's going to own a home for the next 20, 30, 40, 50 years. You're gaining wealth right now in the stock market with your other 401ks or maybe your index fund or whatever you got. But when you own a home, now you're gaining wealth in real estate, which is a part of every wealthy person's financial portfolio. And real estate, it's one of the most stable investments available. Now, in today's economy, when affordability is more difficult, take the math from the episode of 460. You know what I'm talking about? The 6 columns, the advantages of home ownership instead of using the 3 columns. That'll help you understand where the extra quote unquote savings comes from in a home. You're going to hear that philosophy behind the math of divestment and diversification, and it should be blowing your minds. I've got a bunch of interviews inside the podcast library from buyers in high cost of living areas who seriously had to check their spreadsheets 2 or 3 times. They were shocked when they saw the real numbers in the gains. They assumed that there was no way that at today's prices and today's interest rates that they could buy a home without totally sacrificing their investing plans. And this is where I make sure I tell you, everyone's financial situation is different and everyone handles their money differently. But when you really dig deep into the numbers and make them foundational, just like you do say, well, when I'm, putting my money into an index fund, I'm assuming 6 to 8% return every year. Well, how come we can't do that with home appreciation, even though it's got the exact same 100 years of data that Wall Street has? Why can't we do that with a rent replacement strategy? Oh, because no one teaches it except on this damn podcast. Please spread the word, because understanding all of your creative options is going to be massively eye-opening when you've got that right formula. Combining these first 2 techniques, the low down payment strategy plus an adjustment to current contributions, it can mathematically make a higher monthly payment, not just affordable, but actually more profitable. All right, you waited long enough. Here's 2 new creative tactics. I teased them up at the top of the show. Now, these are going to be a lot easier to wrap your head around now that we've gone through everything to get here and you've got the math and understand how to work your monthly budget adjustments. So number 3, well, what if you can't use a low down payment strategy right now because you don't have 5% or 10% to reduce to a lower one? What if you don't even have the 3% for a low down payment? And you listen to all this and you're like, dude, this sounds good. And I want to get in on this lucrative plan, and that sounds like I need to own a home as soon as possible, right? Well, using the same principles we've just discussed, you can temporarily reduce your contributions into anything else that you got going on and move those over so they can fund your down payment fund. It's the reason I put this here at the end, because now you've had time to digest and process the math. Now you've had time to really understand the why this is happening and the how of all this all works. This creative solution, it's a pretty easy leap to make. If you're short on your down payment, you want to get into it and you want to get things started as quick as possible. Well, step 1 of the very, very first 10 steps here at How to Buy a Home and how you get started buying a home, it's decide. So if you're short a down payment and you're like, well, I don't know if I really want to do that to sacrifice. No. Understand the numbers. Decide. Once you believe, you'll make the right decision and the math will reveal everything to you. You got to believe in the math instead of waiting and hoping for outside forces to create a more simple, simpler What am I trying to say? How about a simple mathematical path to affordability in the crazy and illogical housing market of 2026? That's what I was trying to say. Gang, can you tell I'm a little passionate about this? This is the one thing that I know, and this is going to sound incredibly hyperbolic and probably even arrogant to say it, but the reason the average age is 40 is not because homes are expensive right now. It's because the entire industry and Zillow and Redfin and the online lenders, they don't give a crap about you. Nobody's teaching this, and an entire generation is being left behind. And I'm so confident in this that I'm confident to explain this one to you, which a lot of people are going to think I'm crazy. But I'm going to continue to be passionate and tell you that another way to fund your own down payment is to use your own 401k or Roth IRA savings, withdraw from those and fund your down payment. Don't lie to me. Be honest. Come on. Who freaked out a little bit? Well, that feeling, that's been implanted in you by your parents or your financial advisors who, it's not their fault either. They haven't seen the math with today's high rents. They don't understand how this works. The only way it can work. You need new tactics that understand your current situation today. You can't just do it the old way and everything's going to work out just fine. You can't just work hard, invest in a 401k, slowly and incrementally in time, and then save up to buy a home. Yeah, 5, 10, 20 years of saving while you're paying this expensive rent. Yeah, by the time you end up buying a home, any of the gains you would have had were lost. The math today just doesn't line up. And if you don't have enough money to fund the down payment that you want, this is what I'm telling you. You may already have the money. Your down payment's hiding in plain sight. You're just looking in the wrong account. And this tactic is not taking away from your retirement. We're not irresponsibly buying something just because it's a vanity purchase and makes you feel like you're actually adulting. No. This isn't anything to do with the emotions behind it. You're reallocating your retirement funds for growth somewhere else that has a larger potential based on the time that you purchase it. And right now, your 401k, this is the thing a lot of people don't understand. It is solely dependent on Wall Street. If that's the only thing you've got, you're not diversified. That means all your eggs are in one basket. You could be in trouble. Buying a home adds real estate to your portfolio, and now you have a second asset class. That's how you stay protected. And here's how it works. Many of your 401k plans, they allow you to borrow up to $50,000 or 50% of your vested account balance, whichever one is less. And here's the kicker. It's a non-taxable event in the purchase of a primary residence, and there are no penalties or fees to do so. That's pretty incredible. And the other one, your traditional Roth IRAs, you can get up to $10,000, and that one too is a penalty-free withdrawal for first-time homebuyers. Now, I've already explained the math behind this, but there's something a lot of people don't talk about. Like, if you really break down finances and understand how this works, this should be a gigantic indicator to people. An indicator that this technique, that it has merit. Let me explain. The money managers, they know that homeowners are 43 times wealthier than renters. So they're the ones that created this. The money managers, the people trying to make money off of you. So why on earth would they create something that is a giant loophole for you? They're not. They're doing it because they know that if you become a homeowner, you're going to have 43 times more wealth, which means you're going to have more money to invest. So they're offering this advantage to you, their clients, so they can make more money off of you because you're going to have more money as your investment grows. There's a natural understanding that doing this is not irresponsible. Doing this is actually just diversifying how responsible you're being at a young age. And if your 401k is your main investment vehicle and you don't have a bunch of other investments out there and you don't have a bunch of gold buried in your backyard, well, then maybe you might want to start thinking about diversifying it sometime. Because in uncertain economic times, does that sound familiar to anybody? Well, then diversification of your portfolio isn't just smart. It's really freaking essential that you do so that you can survive. Because if you've just got a 401k and that's it, and it's all in the stock market. Well, one crash in the stock market, your retirement gets cut in half overnight. And nobody from your 401k is going to call you to tell you, hey, there's a chance that this 401k fund that we got going on, it could get Thanos snapped and wiped out by half overnight, turned to dust, those little sprinkly things coming at you. So our advice to you is that maybe you should diversify. Yeah, no one's calling you to tell you that. And I've said it this way before. You can use the money you've been saving for your future to buy your future today, a future that exponentially compounds in worth. Now, depending on who you talk to, a lot of people might think I sound like some infomercial guy trying to sell you some get-rich-quick scheme, or just some guy trying to sell you a bunch of homes that he bought and he needs to get rid of them. But I can tell you, for years now, thousands upon thousands of first-time homebuyers, they use this technique every single year. And you can hear it straight from other buyers who had questions, and then when they did the math, they ended up doing it. They're in our interviews. I'll put them in the show notes. It's, 113, 135, 161, 163, 273, and 369. And those are just the ones I could remember. I haven't been able to go through all the interviews. Those are the ones I knew, they did use their 401k. The tax-free element of this has been documented, and I've had many other people who have gone through the process tell me that that's the way that it works. But I am not a tax man, so I'm not giving you legal tax advice. Make sure you check with somebody to find out exactly how it works. And also make sure you check with your individual money manager account, because the person who manages your account, they all have different rules. So the bottom line on everything, I've been saying it since I started in real estate, because right after my first couple of years, man, the one thing I heard from all my clients was, boy, they wish they'd bought sooner. Because we took so much time breaking down all this math and explaining it to them, when we got into it, they were like, to a person, every single one was like, gosh, this rent replacement strategy thing, we could have done this before and paid less money in rent and started earning all the compoundingness of the home earlier. So yeah, it might feel tough to buy a home right now if you don't understand all this, because the earlier that you participate in the market, the more years that you have that new asset, that investment to grow. This has been a lot. Actually, most of the information I've been giving here in 2026, all this is a lot. But this is a culmination of everything I've learned over 20 years. And most importantly, this is the new way for us to create economic democracy. It's gonna feel like it's tough to do this, but it's not. It's just the general public isn't being told this information. And slowly but surely, we're seeing lots and lots of people get left behind, because the billionaires don't make money explaining things on a low level to so many different people. They leave that up to the individual industries. And gang, the real estate industry, they've left you high and dry. But you know what? I've been extremely passionate about economic democracy and bringing power back to the people. And I understand sometimes passion can get a little blowharvian. I just made up another word. So fine, don't take my word for it. Go back and listen to the math. Then you decide what you want to do. The math speaks volumes. So why don't you go ahead and turn up the volume? Turn it up to 11. You can do this.
Looking for more DIY education or your own personal step-by-step guidance through the home buying journey? Since 2019, How to Buy a Home has been the #1 resource for first-time home buyers. So visit howtobuyaHome.com to get started.